I'm Jeff McLeod, and this is the Buyer's Guide to Fixed Deferred Annuities with appendix for index annuities. I'll breeze through the main section first, and then we'll spend most of our time on the appendix for index annuities. Prepared by the NAIC, which means National Association of Insurance Commissioners. This association helps the various insurance departments coordinate insurance laws for the benefit of all consumers. So this is a document from your insurance department. This guide does not endorse any company or policy. And when we speak, I will email this to you. What is an annuity? ANNU means annual. IT means stipend. So it's a 2,000-year-old Latin word that means annual income. And only an annuity can pay an income that can be guaranteed to last as long as you live. That's a very serious word. Only an annuity can use the word guaranteed. Only. Nothing else can guarantee you an income that can last you as long as you live. There are different kinds of annuities. There are single premium, multiple premium, and flexible premium annuities. When you put your dollars in a bank, it's called a deposit. The word deposit means loan. But when you put your dollars with an insurance company, you're not loaning your dollars to the insurance company. You're insuring your dollars. That's why it's called premium. So you have car insurance premium, health insurance premium, life insurance premium, your annuity premium. Flexible means you can add to it anytime you like. Immediate, since the word annuity means annual income, immediate means income that now. And deferred has nothing to do with taxes. It means income later. There are two types of annuities. Remember, this is the buyer's guide from the insurance department. There are only two types of annuities. There are fixed and variable. Fixed means fastened with guarantees. So the word fixed doesn't necessarily mean fixed interest. It means fastened with guarantees. Variable means your dollars can vary with much risk. So your dollars can vary up and down in a variable annuity. Now let's look at the different surrender charges. Oh, this is the best part, actually, about an annuity. This is what enables an insurance company or the annuity to use the word guaranteed. It is a known factor. It declines and disappears over time. I'll go into this later with you, but it really is the best part about the annuity. You do enjoy free withdrawals. Most fixed index annuities do not have a contract fee, a transaction fee, or a percentage of premium charge. Some states do charge a premium tax. Now let's go to the appendix. All annuities are required to give a free look period. It's the only financial vehicle you can buy in the entire United States where you're allowed to think about it after you receive it, after you've purchased it for 30 days, mandated by state law. That's some states it's 10 days, but most states 30 days. Pretty amazing. And here's all the questions you should ask when looking at an annuity. Now let's get to the appendix. Let me move something out of the way. Okay. When this guide was written, the word equity was used. It's now omitted. And I have another buyer's guide, an updated buyer's guide to review with you. And now they're just called fixed index annuities. What are indexed annuities? An indexed annuity is, look at this keyword I'm highlighting, a fixed annuity. And remember, the word fixed means fastened with guarantees, either immediate, which means income now. So yes, you can buy an index annuity that provides income now, or deferred, that means income later. Deferred means income later, that earns interest. So a fixed index annuity is an interest rate vehicle. It earns interest or provides benefits that are linked to an external reference that might be tied to the S&P 500 or other indexes. Look at what the insurance commissioners say here. When you buy an index annuity, you own an insurance contract. You are not buying shares of any stock or index. You own a contract. It's not a security, it's not a bond, it's not a loan, it's not a deposit. It's a guaranteed contract. How are they different from other, using voice inflection here, from other fixed annuities? An indexed annuity is different from other fixed annuities because of the way it credits interest to your annuity. Some annuities credit interest calculated at a rate set in the contract. Other fixed annuities credit interest rates that are set from time to time, like a fixed rate. Index annuities, by the way, fixed rate annuities are really hot right now because we finally have higher interest rates after 40 years of declining interest rates. I started in 1982 at the very top of the interest rate cycle. So my entire career was declining interest rates, but now the fixed rate is really, really good. But index annuities credit interest rates using a formula based on changes, and I'm going to show those formulas to you, based on changes to which the annuity is linked. The formula decides how the additional interest, if any, is calculated and credited. How much additional interest you get and when you get it depends on the features of your particular annuity. Your indexed annuity, like other fixed annuities, also promises to pay a minimum interest rate. Look at this. And this is mentioned again in the buyer's guide. Promises to pay a minimum interest rate. That's guaranteed by law. That's controlled by your state insurance department too, by the way. The rate that will be applied will not be less than this minimum guaranteed rate. So you have two things going on all the time in an annuity. You have your current rate and your minimum guaranteed rate. The value of your annuity will not drop below a minimum. There it is. The value of your annuity will not drop below a minimum guaranteed rate. Let's see here. Indexing methods. So the indexing method means the approach used to measure the amount of change, if any, in the index. Some of the most common indexing methods, which are explained more fully later on, include annual reset. And notice the insurance commissioners. I have dyslexia, so I talk backwards sometimes. You just reverse it and you'll know what I mean. Ratcheting. So they use the word ratcheting, and I will reference when we speak an example of a socket wrench. They work just like a socket wrench. How you make interest. One of three ways. A participation rate. That means you participate with the insurance company in the rate of increase on that index. Okay. So for example, if the calculated change in the index is 9%, why they use 9 and not 10, an even number, I don't know why, but they did. is 70%. If the index linked interest rate in your annuity, the index linked interest rate in your annuity will be 6.3%. So if the S&P 500 goes up by 9 and your participation rate is 70% of that increase, then your interest is 6.3%. Cap rate. Some annuities may put an upper limit or a cap on the index linked interest. This is the maximum rate of interest that annuity will earn. In the example above, if the contract has a 6% cap rate, your cap rate will be 6% and not 6.3. 6% would be credited and not 6.3. Not all annuities have a cap rate. Notice it uses the word some. I want to give a quick speech here on this. Let's say we have a 50% participation rate and a 5% cap rate, and the S&P goes up 10%. 50% means you'd make 5, but if you have a cap rate of 5, then you'd make 5. Which is better? One's not better than the other, but let's say the market goes up 20%. Well, 50% of 20 would be 10. But if you have a 5% cap rate, you're still at 5. Now let's go back down. Let's say the market goes up 3% for the year. 50% of 3 would be 1.5. With a cap rate of 5, you'd make all of that 3. See how that works? Okay. Now let's go a little further. The floor is the minimum linked interest rate you will earn. The most common floor is 0. A 0% floor assures that even if the index decreases in value, the index linked interest rate that you earn will be 0 and not negative. Remember, it's a fixed annuity. Your dollars are fastened. In all cases, your fixed annuity will have a minimum guaranteed value mandated by state law. Each state has its own minimum guaranteed interest rate that an annuity can pay, or the company just won't do business in your state. In all cases. In some annuities, the average of the index value is used rather than the actual value. Okay, let me start explaining some of, well, I'm going to come back up to that. The next way to make interest is called a margin, spread, or administrative fee. A lot of people against annuities use these words to scare people away from fixed index annuities, but let's look at what the insurance department says. In some annuities, the index-linked interest rate is computed by subtracting a specific percentage from any calculated change in the index. This percentage is sometimes referred to as a margin, spread, or administrative fee. Now remember, this is a computation. It is not a fee of your principal. Might be instead of or in addition to a participation rate. For example, if the calculated change in the index is 10%, now they're using an even number. It gets easier now. Your annuity might specify a 2.25% margin, spread, or administrative fee will be subtracted from the rate to determine the interest rate credited. So, if the calculated change in the index is 10%, and in this example, the rate would be 7.75. So, if the index goes up by 10, you subtract the 2.25% margin from the gain not your dollars, not your principal, not your premium. And your credited interest is 7.75. See how those words can be used to try to frighten people away from these? Most articles on the internet use those words in a negative light, and it's total misinformation. That's why I'm using your insurance department's guide. In this example, the company subtracts the percentage only, very powerful word, only if the change in the index produces positive interest rate. So margin, spread, or administrative fees are not deducted from your premium, your principal, your dollars, your death benefit, your accumulated value. It's only to compute how your interest is credited. I want to spend a lot of time there because of, uh, uh, you know why. Vesting. Some annuities credit none of the index-linked interest or only part of it. All of the annuities I present to you vest the interest once it's credited. And remember, the word annuity means annual, ANNU. So most of these have annual reset. Let's go back up here to the buyer's guide. See this word right here? Annual reset. That means your interest is credited annually and it's vested annually, and then you compound and reset on top of that. Averaging. Let me show you. Below this video, I'll have links to other videos that explain. Here's I wonder if you can see this. Hope so. See, behind my head here is an explanation of annual point to point, point to point, and monthly averaging. Here's how point to point works. Here's how annual monthly averaging works. Here's how annual reset works. So I'll place links to these videos. They're about 2.5 minutes each about how monthly averaging works, annual reset works, how point to point works. We don't see high watermark and low watermark in fixed index annuities anymore. This was printed in 2007. Point to point, averaging. I'll explain this real quick instead of reading it. Look at my picture here. See, right? Yeah. Well, look behind my video. You write down where the Dow or the S&P is on the day your annuity is effective, and each of your month anniversaries, you just write down where the S&P or the Dow or whatever index it is. You just write it down on a sheet of paper. At the end of the year, you've got 12 figures written down. You add them all up, then you divide by 12, and that's your average. And then you have a cap or a participation rate or a margin of that gain. So let's say see how the market can be equal. Let's say it begins at 1,000 and ends at 1,000, but all of the months in between are up above. So your average is a positive. Well, let's call it 10%, and let's say your margin is 2%. Well, you take 2 away from the 10, and the balance is your gain, 8%. Go below this video, click on the links to other videos, and you'll be able to see how monthly averaging works, annual point to point, monthly point to point, annual reset, and we will talk to you soon. Thanks for joining us. Oh, let me show you the other buyer's guide. Here, oh, no, oops. Hope I didn't close. There we go. Here's the updated buyer's guide in 2015, prepared by the National Association of Insurance Commissioners. Basically the same, little worded a little bit differently. There is one spot I wanted to show you. Illustrations. That's something you need to request, an illustration, a sample policy. But when you see the illustration, that's controlled by the insurance commissioners as well. What the insurance companies can show you, it has to show the guarantees and what the interest rates have done historically. So this is a very, very good thing to request. One more quick item. So again, in the newer buyer's guide, see how they're using the word fixed index annuities? They've omitted the words equity indexed annuities. My number is 501-658-9882. Text or call or click. I like that. If you have any questions, take care.